How do you see the day ahead shaping up? Of course, we had two big tech reports, those companies moving in different directions right now.
The Bears, Frank, clearly have been in control. This whole higher for longer from Powell, the rise in long-term rates, and the speed in which those rates have moved up. And of course, you have the Mideast and oil going up in turn. The bulls, on the other hand, I think can hang their hat on the fact that, in our view, the Fed is on perma-pause. They are not raising rates any longer. Employment numbers are still robust. We're seeing more people enter the job market. And then lastly, earnings season. Yes, we got some mixed results last night, but by and large, we're seeing most companies beat expectations. So recession, that's still in question. Earnings recession, that's still up for debate.
All right, so we've got a little debate here. You're looking at both sides of the coin. With that in mind, Jason, what is your WEX word of the day?
I would say boring. So in spite of big tech delivering on earnings by and large, I think it's time to downshift from the Magnificent Seven. We are bullish on boring. So it's not only utilities, but it's bonds, it's preferreds. You can get equity-like returns in asset classes and sectors that generally are defensive and boring. You take municipal bonds, for instance, and I know I'm predominantly focused on equities as someone who's a senior portfolio manager, but you're a New York resident, highest tax earner, you're getting over 6+% on a municipal bond portfolio. Or you get preferred stocks that are down over 10% from their highs, 6-7% yields, wearing the black eye for the regional bank crisis. So boring is the new sexy.
All right, so boring is the new sexy. Kind of explain this thesis. I want to go back to utilities. We've had a number of our guests on in recent weeks. They're saying they got to get out of utilities because of the rate pressure. As we've seen yields just a short time ago on the 10-year, top 5%. Why do you want to get into utilities now?
You want to buy from the fearful and sell to the greedy. Look, I understand the thesis why utilities are out of favor. They have large CapEx spend, and that hasn't helped. But utilities are effectively bond proxies. As rates have gone up, utilities have gone down. So now is a great entry point when you have a 17% drawdown from the high. These are safe havens in times of adversity. You have stable revenue, high levels of regulation. You have earnings resiliency. And again, I'll come back to this thesis. You're getting paid while you're waiting. You're getting almost a 4% dividend yield.
All right, to your point, utilities did come off their best day since April, finishing up 2.5% yesterday, as we saw those yields ease back a bit. I want to look ahead to the day ahead. Any other things that you're watching for in this day ahead?
I'm looking to see the reaction, not so much to the earnings, but rather the guide. You've had this resiliency in the Magnificent Seven, and they account for the vast majority of the performance that we've had this year. We all know that all too well. But it's the guide, and that's what you're seeing with the reaction of Google, and the inverse in a positive way with Microsoft. It's all about the future, not the present or the past.
All right, so you're kind of making boring your wheelhouse. Any other boring ideas or other boring things we should think about? Big tech, a lot of fireworks on both sides of it between Alphabet and Microsoft. Even looking at Meta, there's a lawsuit there. Any other boring ideas outside of big tech that you think investors should focus on?
Yeah, and I want to be clear about this. You know, tech took us to the party. They may not take us home. That doesn't mean you abandon it, you right size it. But take a look at industrials, another boring sector. But you know what, Frank, they're the picks and the shovels to the gold mine. You think about the exponential growth you're going to see in defense spending now, or all this or onshoring, or the energy transition, or how about the $100 trillion required infrastructure spend that will happen around the world in the next quarter of a century? You're going to need industrial capacity to accommodate all of that. And it's an ideal entry point with the ISM PMIs near historic lows. So again, another boring sector that looks very attractively valued relative to elevated PEs for the S&P. Right. The valuation of the industrials look very low.
All right, before we let you go, we got to get a little bit of excitement. Mega cap tech, again, Meta reporting its earnings after the bell. Forward PE of 23 times. Under some pressure right now after that lawsuit announcement. What's your take on Meta?
I think that Meta has really demonstrated that they can continue to reinvent itself. That being said, I do think that you're seeing consumers and businesses being very tentative with respect to spending. You saw that in the Snap results. So I do think that a lot of these big tech stocks could be priced for perfection, at least for the time being.